Welcome back, guys, to another roundtable. My name is Adam. I have Rusman.
Hello.
Victor.
Hi, everyone.
Thank you for joining us. And today we're going to talk about markets reaching an all-time high in the US. So very high, all-time high. Okay.
Scary times.
So scary.
Yeah.
A lot of people are very happy.
Yeah.
Very happy.
Make money.
Yeah.
That make us scared.
This is the thing we're going to discuss. So right now, markets are all-time high. People are happy.
Yeah.
Everyone feels good about the markets.
Yep.
But
on top of the
to you,
world.
it's scary,
Yes,
right?
to me it's
so we're going
scary,
to discuss this. Just give you some context. I think the S&P 500 is about 4,900 points, thereabouts. The Dow is at 38,000 points.
Yeah.
So these are all-time highs in the whole of history. And of course, we want to find out, what we can do when markets are so exuberant. What should you do?
Yeah.
How do you prepare for what could come next? And of course, I want to find out more what are the valuations like as well. So tell us a bit more about that.
Yeah. So the more interesting things that we just had the webinar, I think last couple of months, and during these two sessions, there were a lot of questions that people actually asked me whether the market is going to crash in 2024. Okay. So I actually don't know.
Okay.
Right?
Yeah.
But what I usually do, when we are in the bull market, okay, you got to look at a few metrics. Okay, so there are a few metrics like you can look at the typical ratio like Buffett ratio, where this is basically as a percentage of United States stocks market against the GDP. Okay, so anytime there's actually the percentage is actually above the 100%, it's a sign that the market is over.
It's more expensive.
It's more expensive, more overvalued. So if you look at the charts over here, I think we can see that this buffer indicator currently now it's actually at about slightly above positive 1 standard deviation.
Okay.
It's going up very close to the 2 standard deviation. So this is based on Warren Buffett guide to tell whether we are in an expensive market or a cheap market. Okay. And of course, there are other indication that people will look at, like your CAPE ratio, cyclical adjusted PE ratio, and this will be based on the average 10 years earning of S&P 500 companies. And so based on that, I think if you look at the metric also, now we are also at above 1 standard deviation. Okay, so it's also pointing into the same directions. The US stock markets are expensive. Okay, and of course there are other people who also look at like this curve called inverted yield curve, and that historically, if you study the curve, I think big crisis that usually happens when the yield curve start to get inverted, right? And that's the time where the next crisis will come. So now we are also at a junction where in 2022, 2023, the inverted yield curve has been negative. Okay, so it's pointing to the same direction that the market might potentially crash.
So the curve was inverted in 2023, and the trajectory looks like that.
Yes,
in this year as well.
Yep.
Okay.
And also the fear and greed index is show extreme greed.
Okay.
Yeah. So the market is very, very, very
so
happy.
all the signs point to like a market that's exuberant. People are happy. It's expensive. They think prices can go higher and everything. Do you think that's the mood right now? What's your feel?
Yeah, so I think if you speak to anyone who invests in the US market, I think they'll be happy because a lot of stocks, especially your Magnificent 7 hitting all-time high. I mean, our US stocks are doing very well, right? So, and people will be like, oh, stock market, it's a way to go, especially in the US. Dump China and invest in the US, and a lot easier to make money in the US right now. Okay, so even in the news, you see that, you read the news, it's like, everything is so positive, the job market is good, and then the Fed is also expected going to cut rate this year. So I think if you read the news, generally the sentiments are very good. Right? So it's perfect time for us to make money, and everything is going up. Everybody is happy, right?
Even the VIX index is at all time. It's like at low,
VIX index is basically a volatility index. Okay, so generally when there's a crash, the VIX index will go up to 40, 50, 60, 70, 80.
Okay.
Right, and now we are at all-time low. I think at this time recording is about low teens level.
Okay.
Right, which is also a sign that the market seems to be quite calm.
Very happy.
Okay.
Yeah.
So when this happens, I mean, you've gone through many business and market cycles. When this happens, what do you feel? Do you feel like your spidey senses come on or something like that?
Yeah.
Oh, spider senses.
We are generally more cautious.
Cautious.
All right. When we go to invest in the market. Okay. But in normal, like maybe you're new to investing, a lot of people will say that, seems like the crash is coming. I want to sell all my position.
Oh, really? You feel some people
may like
that?
Or some people say that, okay, I'm going to go in some more.
Right?
Okay. But my take is sometimes try not to time the market, but we see what the market serves you, right? So because sometimes bull market can run a long time, so you don't know when that the bull market will last all the way. Maybe it can drag for another next 3 to 5 years. You never know, right? Okay. Yeah. So you're just down there, and if you are holding good company, continue to hold them. If it get too expensive, based on the valuation and the share price and the intrinsic value, then you may just want to do some slight trimming. That's all only, like to beef up your cash position. Right? If not, try to stay in the market.
Okay.
Right.
Yeah. So and the thing here is that a lot of past big crises, even though usually those big crises happens after the yield curve get inverted, like the one that we saw in the 1990s, 1989, 1988 that year, and then the crash in 2000. Okay, where during the tech bubble, and then of course 2006, 2007. Okay, so this negative inverted yield curve, the next thing that happens is the big financial crisis. But all these financial crises that happen usually due to the fact that because there are black swan events. Okay, so black swan events like those like .com crash. Okay, and then in 2008, of course, you saw the Lehman Brothers collapse. Okay, a lot of these type events people don't really expect it to happen, and that's why the panic selling start to comes in, and that's where the crash happened. And then we saw that in I think 2020 during the COVID. Yeah. Right. Yep. So those are what we call black swan events. Okay, so even though what Victor said that the market may be on the high side, inverted yield curve is negative now. Okay, this music may continue to play on. Yep. For the next few years, we don't know. Okay. Right. So, but when the next black swan event comes, and that's the time where the market crashes. The problem is we don't know when that will come.
Yep. Yeah, that's the definition of a black swan, right?
So you really have to be prepared for all this, right? You have to beef up your cash. That means you know that okay, this is a very happy market. I just need to beef up my cash to prepare on it. Okay. So that's why one example of why I'm saying that the bull market may run a long time, right? Is because if you go back to I think 95, 96, at that point of time, people are calling the market high, and the valuation is very, very high at that point of time. But yet the market runs all the way until 1999 to 2000 before it crashed. Okay. Right. So there's always time for it to run. So but those who exited. If you read the book Bull, right, a lot of value investors exited in the 96. Okay. So they have been sitting on their cash for
5 years. So they lost out on like 5 years of gains.
Yeah, correct.
In a way.
Yeah.
Okay.
So sometimes it's not like the market's expensive. You can always trim your position, but not exit fully. Right, always be in the market. It's just that whether you have more stock or more cash. That's all.
You don't have to do like an either or position.
Yes,
right? It's
correct.
not like all in or out. It's just like how much in, how much out.
Correct. Yeah.
And you do that on a stock by stock basis.
Yes, correct.
Okay.
Yeah. So if you look at I think Warren Buffett cash allocation, over the years on the Berkshire level, you get to see that the percentage level of cash that he has hold on his portfolio. It will typically drop during the crash, like 0809 to teens level. Okay. And then during the bull market, like 2005, 2006, 2007, 2008, the percentage will go up to like 25, 30%. Okay. So right now, I think we are in the market that is considerably quite expensive. So the amount of cash that you should be holding on your portfolio, all right, should be between 20 to 30%. Okay, if you don't have that percentage in your portfolio right now, you might want to look at some companies that you have exposure in the US, and then consider paring down for the to beef up the cash. Okay, but of course you might also want to stay invested. Okay, because there are times a lot of people say, the market is so expensive, inverted yield curve is now negative, the market is probably going to crash. I'm going to cash out 100%, and then I wait for the crash to come, and then I go in.
But this is purely timing the market, which is
that's timing.
Almost
you'll never get it.
You'll never get it. Yeah. So it's much better to just trim, like you said, trim your positions, or if maybe you don't have to trim it, but because let's say you have active income, and you set aside money every month, every year, it builds up your cash position. But you don't exactly have to invest it straight away. Yeah. Because you're waiting for the right price, and at this market, it's not so easy to find something that's worth the price and the value.
So basically now what you need to do as an investor is that you have to So I think right now what you need to do as an investor in the bull market, is that you need to prepare yourself for the next crash.
How do you do that?
Right. So the white Noah rule always say, right? Predicting the rain doesn't count. Building the ark counts, right? So this is a time where you want to build the ark, right? So right now, when you're in the bull market, what you should be doing is, of course, you have to beef up your cash, right? That's one thing that you need to do right now. And anyway, there's a lot more difficult to find opportunities in the US. So that building up cash is, I think, is a natural process that you should be doing. And of course, the second thing is, when the crash comes, you need to bear in mind that you might be out of job.
Oh, okay.
Because that's where a lot of retrenchment happens. In the crisis, I think you saw that in 2020, a lot of people were out of job, right? They were retrenched. And so in every major financial crisis, there will be retrenchment. So you need to prepare yourself, so beefing up cash for investment is one thing, but you yourself also personally have to beef up your cash for your own personal expenses. So that's where you set aside 6 months to 12 months of the emergency cash. And this cash you're not supposed to touch. Because you need to prepare for the event when the crash happens. Your business might be in trouble, or you might lose your job.
I think that's a good point, because when markets are exuberant, people also feel happy.
And
they tend to spend more. Or they buy a bigger car, or they buy a house that maybe
they take more risk.
They take more risk, right? Because it's like they feel like the good times will keep rolling on. But what you're saying is that, you know what, things could turn at any moment. You don't know when. Could be 5 years from now. But it just makes sense to, like you say, build your war chest of cash, and in case anything happens,
raining days will always come.
You're ready to take advantage of it. Right? So that's what you're. I think that's great. That's a great way to look at it.
And of course, the other thing is if you have debt, high interest debt, you need to pay it off right away. Because if you're incurring 12%, 15% a year kind of interest rate, I mean, it doesn't make sense at all.
I think it's 24% for credit cards.
24%,
28%.
Some people might borrow money from loan shark.
Those interest rates are crazy.
But if you have a mortgage for your house, I think it's fine. If the interest rates are reasonable, it's okay. So I think having emergency cash basically is important to prepare yourself for the cash, for the crash itself. And the other thing, of course, you need to be doing right now is I think most of us probably are insured, right? So, but some people, if you are watching this, you are not well insured. It's a good time to do it right now while you have a job, right? You might want to get your critical insurance, your hospitalization, some of those insurance that are very important, like even your life insurance, right? So and the last part, I think, once if you've taken care of all these basic necessities that you need for your daily life or expenses, what you need to do is, of course, besides building up the war chest, you also need to build up a list of companies that you are ready to deploy when the time comes. Because when the crash comes, you don't have the time to do research. You don't have time to watch this podcast. You will be in the market, 24/7.
I mean, the things are going all over. I mean, everyone who's watching this can remember what happened in 2020. When the markets just like went boom. And if you weren't ready for that, and a lot of people weren't ready, and you didn't know what companies to look at and stuff like that, you'd be like, oh my god, what should I do? What should I buy? It's like, should I get this? Should I get that? It can be like a madhouse, right? So a watch list is very important here.
Very useful.
Because I think recent years, if you were to look at, let's say, the 2018, the tech crash, the 2015, the China stock market crash, you look at 2020, the COVID pandemic, and the recent 2022 crash, right? The recovery is very fast in these few years. Somehow in the US, right, in the past, right, when they crash, right, it may be down like 4 years, 5 years, 7 years. But now it seems like it's getting faster. I'm not so sure why, but this is the trend looking at. So you also do not want, you don't know whether it will crash fast or crash slow. But the most important thing is that you do your homework first before all this black swan comes, right? And when the time comes, you just shoot on it. You don't need to go and do homework, right? If you do your homework during the crash, probably by the time you finish, the stocks just went up already.
That's true. So you want to make sure that you've already pinpointed a few companies that you like. They pass the criteria.
And then you calculate the price that you think that you will be comfortable adding. Right now, I think if you look at those companies, the valuation probably are on the high side. You would not be adding. Although some people, if they just blindly read the news, wow, AI is the next thing, right? So Magnificent is the next thing. So they start to pump in more money at current valuation. It might turn out okay, right, if the AI continue to play out well. But the thing about stock market is a cyclical in nature. Right? The next moment, the thesis may change. Once you start to see a company slow down with their AI expansion, the whole thing will just come back down.
So just to give an example, so many years ago, the story is metaverse, but right now it's AI. It's like it's just gone out of nowhere within I think a year or two.
Yeah, right? I mean, there were a lot of like hyper growth stocks that were really popular post-pandemic.
Yeah.
And then they just fell off a cliff.
Yeah.
80%.
90%. And if you just went all in on those kind of stocks, it's going to be, I mean...
they are not back yet until now.
Yeah, that's true. So, I mean, it's a very risky way to play it. I mean, at the time, it was things just kept going up.
Yeah.
Anyway, we're not saying that a crash is going to happen this year. Or next year, or we don't know, right?
Yes.
But we're just taking it... As a what we're gonna do is that we always want to make sure that we are prepared for anything that could happen whenever it happens.
Yep.
So there's no prediction here. We're not going to say anything's going to crash in 2024, but this is what you always need to do.
Yep. Yes. Yeah. Don't get overly excited.
Yeah. Don't get carried away.
Don't think that you are very good. Right. I think make sure that your egos are in check.
Okay.
And I think always willing to like look out for danger sign. Right.
Okay.
So now is a time where it's very heated and it's very easy to like go into the market and then invest and then it went up. I think we saw that in 2021 and late 2020 when there was a huge bull run when everybody think that it was so easy to make money, so they all went in meme stock, GameStop and all this funky company. Then subsequently a lot of people gave up when the market crashed. So right now is a time where you just want to prepare yourself for the next crash.
So I think it's the same, goes back to I think one of the analogy that Buffett give, you treat the stock market like they offer to sell you a burger. Right now probably the burger will cost you like maybe $30.
Oh, that's expensive.
Then you wait, You wait until the burger selling you for $1.
Better have a Wagyu in there.
So there's always probability that these events will happen, right?
Okay.
So you wait until a very cheap burger, good quality one, then with a Wagyu beef inside, and you just buy it only.
Okay.
Right?
Yeah. I mean, $1 burger, I'm a bit sus about that as well. So why are you feeding me? What's inside that? But it's true. When sometimes when stocks go down, so cheap, sometimes people go like, what's wrong with it? Yeah, and that's why the analysis is so important, because you need to understand, peel back the layers and look under the hood and kind of like really understand what you're buying.
Yeah.
Then you kind of know whether it's worth the price or not.
Right.
Yeah. So
I mean, to put in a real world context, you look at China right now.
Yeah.
Right. It's really cheap, but you can get almost like 20 cents for $1 in some of the assets and all this. But people are just sus about China.
Yeah. I mean, some of them do have legitimate concerns about how the thing is run over there.
Yeah.
It's really up to you.
Yeah, maybe
so sometimes too cheap also not so good.
We'll do a roundtable on China coming up as well. But right now I want to focus on the US because it's I mean the focus is there.
Everybody's happy.
Everyone's happy.
I'm happy.
But it doesn't mean that you're not going to invest. When you see an opportunity,
we will still go.
You will still go in if it makes sense. Even at this like exuberant market. Right?
But we will always make sure that our core cash is always there, right? 20-30% at all time.
But of course, we also not saying that there's totally no investable ideas. There's always ideas in any market condition. It's just that whether there's more or less. It's just that currently we feel that there's much less ideas right now as compared to maybe in 2022. There's a lot more ideas for you to look at. Right?
And I still remember 2022 was the year where it was so pessimistic. Everybody, even Bloomberg economists, are predicting 100% recession. And that was a low at that point of time. And then today, of course, we are all-time high again. A lot of economists got it wrong in 2023.
All right. So I guess it just pays to be a bit more cautious either way you go. And just lean toward one side, as in if it gets more expensive, you just lean toward more cash.
Yes.
It gets cheaper, start to buy a bit more.
Buy more.
You don't have to get it perfect because there's no way you can optimize it, min-max it to the max.
But always in the market.
Yeah, always in the market. Okay, so I mean, I hope that was really useful because I think a lot of people could get carried away in this market. It's the new year, elections are coming up in the US again, so that usually tends to be a bull market usually. But whatever it is, always stay invested. And at this point, you guys, we are just gonna like basically build up.
We are cash. More on the net seller rather than a net buyer.
Okay. Put this way to put it. All right. So I hope that was really useful. This roundtable. So stay peeled for opportunities, but be more cautious because of the exuberance.
And watch out for our next roundtable for China. What to do during the bear market.
All right. So with that, any other things you want to talk about the US at this point in time?
Nah.
That's pretty much it. Okay. So with that, my name is Adam. Rusmin.
Thank you.
Victor.
Thank you.
Thank you for joining us. Any questions about this, put them in the comment section. We're happy to answer you. If you like this roundtable, please hit the like button. Tells you're doing a great job, of course. Subscribe. Many more roundtables coming up, and we'll see you again.